After the FOMC meeting, when the base interest rate was raised by 25 basis points, you can see how the market reacted. Real estate and financials were hit the hardest, information technology the lightest, but all sectors came down. This also bled into the crypto market. We're going to look at the news headlines, and then we're going to look at the actual transcripts and actual data. From the front page of the Wall Street Journal, the Fed raises rates by a quarter point, nods to banking stress. From the front page of Wall Street Journal Markets, the Dow falls by more than 500 points after the Fed rate hike. It's very interesting to note the words, amid the worst banking crisis since 2008. Some more headlines. Bank stocks slump even though Powell says banking system is sound. The Fed chairman also says there's no reason to think that the problems that led to Silicon Valley's banks' downfall are systemic. From the front page of Bloomberg, Powell stresses commitment to cooling prices as Fed hikes rates. Differing Powell and Yellen messages were a lot for the stock market to digest. Astounding that they gave contradictory messages. The SP 500 erased an earlier gain to finish the session down 1.7%. Yellen says the US is not considering a blanket bank deposit insurance. This came as a response to Senator Hagerty's question, are you going to insure deposits over $250,000? Janet Yellen said we haven't even considered it. There's no problem in the banking system. It's being contained. So why look at it? From the front page of Reuters, the Fed sees credit drawdown looming, shifts towards a pause on rate hikes. Front page of the Reuters market section, First Republic shares fall sharply as Yellen says Treasury will not insure all deposits. One thing that's absolutely astounding about this particular response from Janet Yellen. Janet Yellen's response went something like this. If the Fed, the Treasury, the FDIC, and the President, and it's judged as being a systemic failure, only then will they step in and do something about it. And what's really interesting about this, they just stepped in and did something about it. This means that the collapse of SV Bank was in fact systemic, and that's from Janet Yellen's own words. The reason that I wanted to take you through the news first and then look at the press releases and the actual transcripts second is you just can't believe how the mainstream media press tends to report on things. What did Jerome Powell say? The US banking system is sound and resilient. And we know from what Janet Yellen just said, it's not sound and resilient. There was contagion, systemic contagion inside the US banking system. And that's why they all had to step in. Powell also said recent developments in the banking sector are likely to result in tighter credit conditions for households and businesses and weigh on economic activity, hiring, and inflation. The Fed is going to monitor the data very, very closely. This is going to create a lot of choppiness inside markets. Jerome Powell also reiterated that some additional policy firming may be appropriate to maintain sufficiently restrictive monetary policy stances. And because of economic lags, these are not going to be known in advance. If risks emerge, the Fed will be prepared to adjust its stance of monetary policy. They're looking specifically at the labor market, inflationary pressures, inflation expectations, financial and international developments. Janet Yellen's comments are very, very bad if you compare them across to the transcript of Chair Powell's press conference. Jerome Powell said, in the past 2 weeks, serious difficulties at a small number of banks have emerged. Just note this, and remember what Janet Yellen said. This is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, of course in consultation with the President, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. Janet Yellen actually released private information about the nature of these isolated banking problems. They were systemic, and that's why they needed to be acted upon. Chairman Powell went on to say, these actions demonstrate that all depositors' savings and the banking system are safe. Sorry, Jerome, Janet Yellen just let out the secret sauce. Yellen actually said that this kind of action is only taken when there is systemic risk. If you become a student of crashes, what you actually see, financial crashes that is, what you actually see is that the government and market participants are always stepping up, for example in the Great Depression, and they're stepping up and just saying everything is fine, but it's not fine. People tend to believe what they're told by authority figures, and that's of course very reasonable. Being in financial markets for so many decades, it's just like a record that keeps repeating. Jerome Powell is saying, clear and ample liquidity is in the system. Our banking system is sound and resilient with strong capital and liquidity, but they're going to continue to closely monitor conditions. Why would you need to closely monitor conditions if everything was fine? You just wouldn't need to. And he goes further than that and said, we are prepared to use all of our tools as needed to keep it safe and sound. Again, if the banking system was sound and resilient, why would you need to use or be prepared to use all of your tools as needed to keep it safe and sound? This is called Fed speak. As we heard from Janet Yellen today, she's not even considering, the Treasury Department is not even considering extensive FDIC coverage for above 250,000. But yesterday we had a fantastically interesting news headline. US studies ways to guarantee all bank deposits if crisis expands. You can see how the news and what actually comes out of policymakers' mouths can often be different. What you'll find is the reality is in the charts. When we look at the 2020 sell down, we saw the banking system coming down hard. And of course, the SP 500 coming down hard. When we look at what's happening inside the banking system at the moment, it doesn't look good. It looks actually fairly ugly. If we zoom in to price behavior, we can see that the S&P 500 did quite well, but the banking system largely is subdued in terms of the top 15 US banks. A good way to think about the term systemic is from a medical stance. Systemic means affecting the entire body rather than a single organ or body part. For example, high blood pressure, the flu, they affect all of the body, the entire body. And when we parallel that to systemic actions within the financial system, the banks, if they're systemically having problems, that means the entire economic system, the whole body is having problems. If we look at the top 10 European banks, recently they've been coming down too, largely as a result of the Credit Suisse problems. If we zoom in, are these banks recovering? Yes, they've had a little bit of a technical bounce, but technical bounces are just part and parcel of sell-offs. At a time like this, I would urge you to look at high-yield corporate bonds, junk bonds, and especially Bitcoin to try to figure out if risk-on or risk-off is coming into the system. Don't forget, when we get sell-offs, the market always recovers. Sell-offs are a fantastic way to take advantage of negative price momentum if you are prepared. And the prepared sign is very, very difficult to do because a lot of people don't want to sell, especially if they're long-term investors. And I'm, of course, not saying that you have to sell. We are a trading community, so we're in and out. Timing for us is absolutely vital. We cannot afford to get caught on the wrong side of the percentage. It's very important to be able to read between the lines of government policy decision makers. They often couch things in terms that the ordinary person looks at it and say, "What are you talking about?" Jerome Powell says inflation remains too high, labor market continues to be very tight. Real GDP is rising, but it's below trend. Consumer spending appears to have picked up, but it's still getting suppressed by the housing sector, which remains weak due to higher mortgages. This is also offsetting business fixed investment. The FOMC participants generally expect subdued growth to continue. Wage growth is moderating, but job vacancies are still very high. Labour demand substantially exceeds the supply of available workers. The Fed is projecting the total PCE inflation 3.3% for this year, 2.5% for next year, and 2.1% in 2025. But they say it has a long way to go and it's likely to be bumpy. Since the previous meeting, economic indicators have come in generally stronger than expected, demonstrating greater momentum in economic activity and inflation, but not in terms of real GDP. Jerome Powell again notes events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. But I thought everything was fine. I mentioned before about Fed speak. Fed speak is a technique for managing investors' expectations by making deliberately unclear statements regarding monetary policy, to prevent markets from anticipating, thus potentially negating its effects. Why do I raise this? Because you've got some really good Fed speak, really good Fed talk right here. You could anticipate, or you could look at this in a couple of different ways. It's very, very ambiguous. It may sound clear, but it's not really clear at all. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Quell means to reduce. Instead, we now anticipate that some additional policy firming may be required. From a legal perspective, this particular statement is very, very ambiguous. Jerome goes on to say, we will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. Just very quickly, I just want to read you something from testimony of Secretary of the Treasury Janet Yellen before the Financial Services and General Government Subcommittee of the U.S. Senate. It's just down here. I've just highlighted for you. The U.S. banking system is sound. If you go back and look at the news headlines, you have the actual text that the reporters used to write these headlines. The word systemic is coming up again and again and again. Now we need to look at how the markets actually coped with what was going on. Our focus is in looking at actual price action. We just bear in mind what's happening and we stack probabilities based on it. And we know that economic data and economic downturns and upturns can take a long time to play out. What did we see? The VIX is still over a level of resistance. It's actually being supported at the moment. The VIX hasn't spiked like the VIX generally spikes. This is a very wimpy spike in the VIX. The VIX is a very strong animal. It likes to roar. One thing that is really, really good that we see, because we've done a lot of analysis on the GFC, and we saw junk bonds and high-yield corporate bonds starting to collapse and going in line with the collapse of the SP 500. We don't see that now. In fact, we see a crossing of resistance. This could be a very, very good risk-on signal. This is something that you want to realistically just have on your charts every single day. And if you're in the masterclass, I share this chart in TM6. We saw economic confidence spike up and then get squished because of Jerome and Janet. But in truth, we're always getting waves inside financial markets. This is something to just bear in mind. And pre-FOMC meetings, the market does tend to go up. And it does tend to come down afterwards, so just something to bear in mind. There's a lot of mixed signals being sent at the present time. The market is really uncertain where it's at, and we can see this by looking at bond prices, bond yields, gold, and the DXY. The markets are unclear, so we're going to need to stack probabilities to see which direction they could be going. We know from now on the Fed is going to have a data-driven outlook and unemployment claims come out shortly. Our community has a reputation of diving deeply into the data. So this particular data from the FOMC meeting, I'm actually going to overlay that on charts to give you a better understanding. The FOMC sees that PCE inflation is going to be moderating. It's going to be coming down, as well as core PCE inflation. Recently, the Fed did a big injection, but that was to stabilize the banking system from systemic risk. It wasn't a pivot, it was a band-aid. We're going to look a little bit more into break-even inflation rates just in another chart. From the FOMC's projections on real GDP, 2023 looks like the bottom and GDP looks to be going up from there into 2024 and 2025. Looking into real GDP, if we take the December projections, you can see a big hype around here, a big margin, 0.4 to 0.5 and 1 to 1.1. You can see how the projections have moved down, 0.6 to 0.7 and 0.2 to 0.3. This is very important because the banking system crisis has actually pushed the probabilities down. You can see that in 2024 as well. There were a lot of projections from the FOMC members around 2 to 2.1, 1.6 to 1.7. There are none there at the moment. There was even one member saying 2.4 to 2.5. We can see they're all basically hovering around that 1 to 1.1 level. This has clearly caught the Fed off guard. For 2025, there are even stronger projections for real GDP. This means a restoration in confidence in 2025. So it looks like 2023 and 2024 are going to be turbulent years with a very nice recovery in 2025. And then longer run, we can see that the GDP will actually decrease slightly. One thing to take note of, when we look back historically and we've had a falling off of GDP, real GDP, that tends to create recessionary problems. Not always, sometimes it comes up, but most of the times real GDP actually falls. When we look at the FOMC projections, when we look at how GDP is actually coming up, that is a very, very good sign for the market. But don't forget, these projections are based on a number of people's estimates, and all those estimates are put together. The federal funds rate is currently between 4.75% and 5%. If you look at various data sources, you can see that they're not updated. And that means when it comes to charting, the charting is not updated as well. I'm just bearing that for you to understand. So it's up around here, around the 5% mark, just slightly higher. When we look at the FOMC projections, we can see that the federal funds rate is coming down. It's clearly got a negative bias towards it. One thing that people don't tend to look at is the variability around the estimate of the federal funds rate over time. It can be very, very wide, literally up 5.5% to about 0.7%. So just bear this in mind. That's just an on average line. That's the box plot. From our perspective, they're just individual data points. What does this mean for us as investors and traders? And we know every investor becomes a trader anytime they buy or sell. So the key is buy at very good prices and sell at good prices too. That's not a bad thing. You're not taking money out of somebody else's mouth. You're probably letting them in the market when they want to get in. When you're selling, they're buying. I just put a couple of things together for you. I overlaid the GDP, the SP 500, just in very light color, that's Bitcoin, the federal funds rate and the unemployment rate. I also overlaid recessionary indicators because I think this is really good to understand. When the unemployment rate starts to come up, what typically happens inside markets? There's a reasonable correlation between the unemployment rate coming up and recessionary behavior. And that, of course, makes a lot of sense. They say a recession is when your friend loses their job, and a depression is when you lose your job too. We know economically that the job market is really tight at the moment, but we are starting to see a little bit of a kick up in the unemployment rate. And that's what Jerome Powell was talking about, a moderation of wage rate increases. If we inverse the unemployment rate and we compare it to the S&P 500, we can get some really interesting associations. You can see as inverse unemployment goes up, the S&P 500 goes up. This is all about risk-on activity. And when the inverse unemployment rate, wow, what a double negative, it actually comes down. This is just meaning unemployment is going up. You can see its correlation to the S&P 500. It's really quite interesting. It could be just another thing you can keep your eye on. What do we see right now? A slight curling over of the inverse unemployment rate. That means that unemployment is starting to gather momentum. When we look at forward projections from the FOMC meeting minutes, what are they actually telling us? They're expecting that the federal funds rate will start to come down. What happens when the federal funds rate starts to come down? Well, quite a few times we've seen recessionary activity around that period of time. Not all the time, but quite a few times. If you're an investor, I would urge you, please learn how to trade. You're just buying and selling. Buying and selling with timing is a really important thing to do. And you can see that really good professional traders must understand the economic system incredibly well. I'm always looking for good signals to share with you, and if we look at inflation year on year and the S&P 500, we compare that to recessionary behavior, and we look at US core inflation, 10-year break-even inflation, and 5-year break-even inflation. We can see some really interesting things. Note inflation year on year, when it really falls off a cliff, what are the markets doing? They're in general coming down. It didn't occur here in 2015, but it occurred certainly in the GFC and certainly in March 2020 when the whole system basically shut down and we saw a huge spike in unemployment. In the next few days, I'll add this to LV29, inflations and recessions, so you'll have my live chart. Please keep an eye on this one. I think it's a very powerful thing to refer to. The Fed wants to bring inflation down, but what do we notice? What happens when the Fed actually brings inflation down, or the economic system brings inflation down? It can be one of two ways. It's not always the Fed. This is a reason why we are professional traders, because we just want to ride the market, no matter if it's going up or down. There are always opportunities inside the market. This is just one more chart that you can use to stack probabilities. In 42 days' time, the next FOMC meeting will be occurring. You remember that Fed speak that I was talking about? Look at the market. It's saying this is already a 61.2% probability of a 25 basis point increase in the federal funds rate. One thing that we need to be very mindful of is the S&P 500. We had a huge sell down in the S&P 500 in the last trading session, but fortunately there's a lot of smart money that is prepared and has been prepared to step in and support the S&P 500 up. If we see more upside momentum, that is absolutely what we want to see. If we see a weakening of this 39.39, 38.78 and a losing of this resistance, we could be in for some very negative price momentum. Most people, when they're marking up a chart, they'll use recent indicative price. The problem with recent indicative price is it RIPs your money. Why is that? Because the window of the chart that you're analyzing is not the full census of price history. You need to understand all of price to understand current price. The CTKS method gives you that capability. A lot of people will be saying that the S&P 500 is at the 200-day simple moving average, but it's lost its 50-day and lost its 100-day SMA. That's all good and well, but the key is you need to know where things can sell down to and where things can sell up to before the algorithms come in and reverse that position. That's what the CTKS method is for. The other thing to think of when you're looking at a specific financial instrument, for example gold in this case, we saw increasing levels of resistance above gold's price. That was then rejected, and we can see the levels, these smart money buy levels. The 1936 was actually the turnaround in gold's price, and notice the inverse of the SP 500 giving a directional correlation with gold. Keeping your eye on Bitcoin is an incredibly important thing to do. Risk on and risk off is very, very well demonstrated through Bitcoin. We were almost looking good with Bitcoin. It was almost getting out of that smart money sell area and starting to rally. But what happened? Jerome and Janet came into the picture and things were not looking good after that. But do you notice where price bounced from? Could you have predicted this level from recent indicative price? Well, probably not. Bitcoin is currently trading at 27,455. Yesterday, we talked about the smart money buy area between 26,621 and 26,697, and we saw price literally came in, tapped that level and bounced. That's what price does. That's why these levels are so important to understand. These zones, the zones where the algos go to work. What you will find, the more that you look at the CTKS method, the more you will find that price actually ping-pongs between smart money buy levels and smart money sell levels. With the FOMC meeting out of the way, we can see that the longs have been coming out of the market. The shorts are starting to re-emerge, starting to get back into Bitcoin. We can see that 24-hour liquidations in Bitcoin were about double what they were yesterday. Today it's coming in at a cool $250 million, 247.35 million across 66,813 positions. And when we look at total liquidations across the past 24 hours, we can see about 74% long. What about the past 12 hours? 75% long. The past 4 hours? 56% short, gone the other way. And the past hour, 76% short. No such thing as a sure thing inside any financial market. The truth is, the longs and the shorts are always getting liquidated, but it's been more longs getting liquidated recently than shorts. One thing that we know, no alt can escape Bitcoin's gravity. As Bitcoin was selling down, what was Ethereum doing? Selling down. BNB selling down, XRP selling down, ADA selling down, Doge selling down. It's the way of the crypto market. But as soon as you understand this, you can focus on Bitcoin, and then you will get a much, much better idea what you can do with your beloved alts. We were looking yesterday at XRP and ADA. Let's have a little bit of a look at ADA. If you're looking at ADA just with normal eyes, you would say, oh, ADA's overcome a level of resistance. This is good. We've got a bit of support under here. Why did it stop there? Why didn't it just keep on going? Contrast this to having the CTKS method. You would understand that ADA, currently trading at 363, was coming up to a smart money sell level between 377 and 384, and it got rejected. Poor old ADA, never good to be rejected. The real key here is that you can actually look at price action, and underneath these different SCs or Stanfield zones, there's a confluence of SLs or Stanfield levels, and that's all taught through the CTKSmethod.org. All of them have different strengths. We also looked at XRP yesterday. XRP went on an absolute blitz. It was doing so incredibly well. But if we knew the CTKS method and applied it before we did our trading, we would have had a little bit of caution about XRP's rally, only for technical reasons. Let's have a look what it looks like. And we saw the same thing with gold to give you a forward hint. XRP rallied really strongly above this smart money sell area. It went to the next smart money sell area and had so much overhead resistance. When you have so many sellers, so many levels piling on top of each other, you're literally just pushing up against a mountain, a roof of steel, and it will push back on you. But the sellers have been weakened, and this is very fascinating from XRP's perspective. When XRP starts to get above this, the sellers won't have as much ammunition as they previously did. Yesterday, when we looked at the next top 8 alts, we can see that Tron had an absolute bloodbath. What was this caused by? If you see sharp spikes like this and they're not obeying Bitcoin's gravity, you have a news event. You need to go searching. Tron was looking really good yesterday. It had actually overcome a level of resistance. But what we saw, and we saw this with the main market as well, it just collapsed down. When you get a cut under of support, always take note of that. It's a good thing to do some risk off when you get a cut under and a risk on when you get a cut over. I talk extensively about these terms inside the masterclass. We can see in the press, SEC files lawsuit against Tron's Justin Sun and celebrities over crypto securities offerings. What is this actually all about? When you look at the US system, they're trying to prop up the banks. They don't want competitors. That's why the SEC is doing a clampdown, because it already knew the banking system was weak. And of course, Gary had to just hide the ball under the cup. He didn't have a close relationship with Sam Bankman-Fried. Remember that? He was having to go in front of Congress to explain it. But all of a sudden, so many enforcement actions came out of everywhere. Diversion is a #1 thing in politics. The SEC allegations against Justin Sun can be expected to be fought with a lot of legal dollars. The SEC is charging Justin Sun and his companies for fraud and other securities laws violations. They're also charging particular influencers and celebrities for failing to disclose that they were paid money to promote. As traders, we're always seeking to get on the right side of the percentage, and Litecoin has been doing very well recently. So I thought I'd give you a trading perspective on Litecoin. When we look through the CTKS method, we can see that there's reasonably strong support around the $71 mark, say $70, and there's reasonably strong resistance around, say, the $94 mark, just averaging those two. So between $93 and $95. When we look at the current price, if we think about a fall down to this particular smart money buy level around the $70 mark, what you could see is if we return back from that level and challenge this $94 mark, that would be a 34% increase. This is what we call getting on the right side of the percentage. We know that price is always moving between upper and lower limits, between resistance, smart money sell areas, and smart money buy areas. And it's always doing it in a very specific way, trying to come back and retest it. If it's got enough momentum, it will forge through it. Come back, retest, forge. Come back, retest, failing retest. This actually shows you a good piece of your pattern recognition. The key is that when you actually look at anything to invest or trade in, just be aware price is negatively biased. It prefers to come down rather than go up. And when it goes up, it tends to spike up and then take the stairs down. Spike up, take the stairs down. You must be aware of these things. It's very important. If you get on the right side of the percentage, you will make money, full stop. In the stock market and Forex, people say, I must be on the right side of the trade. In crypto, you can be on the wrong side of the trade, but on the right side of the percentage and still do incredibly well. You could do exactly the same thing with the stock market and also Forex. Crypto is an incredibly volatile industry, but that's what makes it so fantastic to make returns from. But you must be prepared. There were so many fantastic comments in yesterday's video. A big thank you to everybody. TSP said, persistence and commitment. Some days will be up, others will be down. Emotions cannot come into play. Just step by step you move forward, even if you need to come a step back to make two forward. For me, the journey is important, not the destination. TSP said, now finally, many decades later, I am blessed to be able to start my journey to be an investor and a trader due to the teachings of the CTKS Masterclass, which is so much more useful than a London School of Economics degree. Thank you for your kind words, TSP. In yesterday's video, we talked about persistence and commitment. Bruna said, I truly believe that sticking to our goals with persistence and unwavering commitment is crucial, especially when we're faced with the difficult days that make it tempting to give up, when we're dedicated to our personal growth and aspirations. Persistent determination is what helps us to keep moving forward. Very, very beautiful, Bruna. Thank you so much. A big congratulations to Sinman. Sinman said, I started the masterclass exactly a year ago. A prodigy of CTKS and positive excellence. Forever indebted to Ken and the CTKS family. Thank you all. Much love. Much love to you, my friend. JT also had a fantastic comment. Without commitment, you never start. But more importantly, without consistency, you'll never finish. I absolutely love that, JT. Keep going, keep growing, keep learning. See you at work. Have a great day, everyone. That's just beautiful, JT. Art had a very, very kind thing to share. Persistence and commitment are virtues that must be in place if we want to get from here to there in one piece. Art says, I don't see myself ever waking up in the morning with nothing to do. I've thought about this day the day before, and I've planned it and visualized how it's going to go ahead of time. My future is not a big mystery. I know where I'm going, and I am committed to doing what it takes to get there. I'm persistent, and I don't often get sidetracked. That doesn't mean I don't take a break and go to the mountains for a few days. And it doesn't mean I don't have fun along the way. Thank you so much, Art, for sharing that. Art continued, persistence keeps me from wandering into areas that don't benefit me or my family. If you are a trader and you're not committed and persistent, then you probably shouldn't be a trader. It takes a lot of work and effort to be a successful trader. I have been at it for over 40 years and I'm still trying to get better and try new ideas. Commitment and persistence keeps us on our toes and thinking of new ideas to solve old problems. Ken is a perfect example of this. He is so committed and persistent that he is always bringing new ideas and inventions to the table. His passion is on display. And it's why I show up every day to learn and feed off the energy in this group of fantastic people. I thank you all for making this a place I want to visit. All the best to you this week. Very, very beautiful art. Today's video took a lot of persistence and commitment to make because there were so many things that we wanted to talk about together. Analyzing all those Fed speeches, looking at the news, creating new charts, it just definitely takes a lot of time. But Kate and I are so privileged and so grateful that we can share this time together. Commitment and persistence are very key aspects if you want to master an aspect of your life, from whatever it is. If you've got the focus that you want to be good in a particular area, you can be great in that area with persistence and commitment. It doesn't matter what it is. But without persistence and commitment, you'll never be great at anything. You have to have that, but you have to have the right reasons to have persistence and commitment. It's not about willpower. You might say, Ken, what is it about then? It's about having a good enough reason. If you have a good enough reason, you can do anything. But if you don't have a good enough reason, you'll just give up on things. I thought that could be really interesting to talk about. Good enough reasons. What would they look like, just in different aspects of your life? I think that's a beautiful thing to share. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye.